Welcome to Lesson 10 of Life Fundamentals for Dummies 16 Things School Doesn't Teach You. Today's lesson we will talk about how to invest money. Investing wisely is a life skill with the power to secure your financial future. In this lesson, we delve into the world of investments, providing essential knowledge on stocks, bonds, real estate, and more. Whether you're a beginner or an aspiring investor, this lesson will empower you to make informed financial choices, grow your wealth, and work toward financial independence. Investing money can be a bit like a roller coaster ride. You put your money into an investment with the hope of making it grow over time. But there is something you need to understand before you start: the relationship between risk and return. Think of risk as the uncertainty or unpredictability of what might happen to your money. Some investments, like stocks, can be riskier because their value can go up and down quickly. Others, like a savings account, are less risky because they are more stable. It's important to know that higher risk investments can mean a chance of losing some or all of your money. Return is what you get back from your investment. It's the money you make or the profit. Usually the more risk you take, the more return you can potentially get. But remember, there is no guarantee of making money, and you might even lose some. Low-risk investments typically offer lower returns but are more stable. In short, you need to find a balance that suits your comfort level. If you can handle some ups and downs, you might choose riskier investments for the potential of higher returns. But if you're not comfortable with risk, go for safer options, even if the returns are smaller. Diversification is a smart way to protect your money when you invest. Imagine you have a basket with different types of fruits. If one fruit goes bad, you still have others to enjoy. It's the same with investments. Diversification means spreading your money across different types of investments. Instead of putting all your money into just one stock or one type of asset like real estate, you invest in a mix of things like stocks, bonds, and maybe real estate too. Why is this a good idea? Because if one investment doesn't do well, the others might make up for it. It reduces the risk of losing a lot of money if one thing goes wrong. Diversification can help you balance risk and return and make your investment journey smoother. Now let's explore some basic investment options you can consider. Savings account. A savings account is like a safe place for your money. You deposit your money in a bank and they pay you some interest. It's a low-risk option, but the returns are small. Here are the pros and cons of using a savings account for your investments. Pros: safety. Your money in a savings account is usually insured by the government up to a certain limit. It's a secure place for your money. Easy access. You can get your money quickly and easily if you need it in an emergency or for short-term goals. Steady and low risk. Savings accounts are low risk. They provide a stable, though modest, return through interest, so you don't have to worry much about losing your money. And the cons are low returns. The interest you earn in a savings account is generally lower than what you could get with other investments. Your money may not grow very quickly. Inflation risk. Over time, inflation can eat away at the purchasing power of your money, meaning it won't buy as much as it used to. Limit growth potential. For long-term goals like retirement, savings accounts might not help you grow your money fast enough to meet your needs. Stocks. Stocks represent ownership in a company. When you buy a stock, you become a shareholder. Stock price can go up and down, and you can make money when you sell them. Stocks offer the potential for high returns but come with high risk due to price fluctuations. Here are the pros and cons of investing in stocks. Pro: potential for high returns. Stocks have the potential to provide some of the highest returns over the long term. You can make a lot of money if the company does well. Ownership: buying stocks means you become a part owner of a company. You can share in its success. Liquidity: stocks are easy to buy and sell, making it simple to access your money when needed. But the cons are risk of loss. Stocks can be volatile. Price can go up and down quickly, and you can lose money, especially in the short term. No guaranteed returns. Unlike savings accounts, stocks don't offer a fixed interest rate. You might not get regular income from them. Research required. Successful stock investing may require time and research to pick the right companies. Bonds. Bonds are like loans you give to companies or governments. They promise to pay back with interest. Bonds are generally less risky than stocks and provide regular income, but the returns are often lower. Let's look at the pros and cons of investing in bonds. Pros: steady income. Bonds typically pay regular interest, make them a good choice for generating income. Lower risk. Compared to stocks, bonds are generally less risky. Your principal investment is safer. Predictable returns. Bonds have fixed interest rates, so you know what to expect in terms of returns. But the cons are lower growth potential. Bonds offer lower returns compared to stocks, so your money may not grow as quickly. Inflation risk. Inflation can erode the real value of your fixed interest payments over time. Lack of liquidity. Bonds are less liquid than stocks, meaning it might take longer to access your money when you need it. Mutual funds. Mutual funds pool money from many investors to buy a mix of stocks, bonds, or other assets. They offer diversification without the need to pick individual investments. They are a good option if you want a balanced approach. And here are the pros and cons. Pro: diversification. Mutual funds provide instant diversification, which means your money is spread across many different investments, reducing risk. Professional management. Expert fund managers make decisions for you, saving your time and effort. Liquidity. You can buy or sell mutual fund shares easily. But the cons are the fees. Mutual funds often charge management fees, which can eat into your returns over time. Limited control. You don't have control over the individual investments within the fund. Market risk. Mutual funds are still subject to market ups and downs. Real estate. Investing in real estate means buying property like houses or apartments. Real estate can generate rental income and can appreciate in value over time. It's a way to diversify your portfolio and can provide stable returns. Here are the pros and cons. Pro: potential for rental income. Real estate can generate rental income providing a steady stream of cash. Appreciation. Over time, real estate can increase in value, potentially leading to capital gains. Tangible asset. Real estate is a physical asset, and some people find comfort in having something they can touch and see. But the cons are a high initial cost. Buying real estate often requires a significant upfront investment, including down payments, taxes, and maintenance. Lack of liquidity. It can be challenging to sell real estate quickly when you need cash. Management effort. Owning and managing property can be time-consuming and may require dealing with tenants and maintenance. Understanding the pros and cons of these basic investment options is crucial for making informed decisions. Remember that your choice should align with your financial goals, risk tolerance, and how you plan to invest. It's also a good idea to seek advice from a financial advisor to ensure you are on the right path. So when you start investing your money, it's important to understand the fees and costs associated with your investments. These fees can eat into your profits and impact the overall performance of your investment. Let's break it down in simple terms. Management fees. Many investments, like mutual funds and exchange-traded funds or ETFs, charge management fees. These fees are like a small part of your investment that you pay to the people who manage the fund. The lower the management fees, the more money you get to keep. So it's a good idea to look for investments with lower management fees. Trading cost. When you buy or sell investments like stocks or ETFs, you might have to pay a fee to your broker. This fee is known as a trading cost. It's essential to be aware of these costs before they can add up over time. Some brokers offer lower trading costs, so shopping around for the best deal can save you money. Expense ratios. For mutual funds and ETFs, you will also want to pay attention to something called the expense ratio. This is a percentage that shows how much of your money is used to cover the fund's expenses. A lower expense ratio means more of your money is working for you. Taxes. Taxes can take a chunk out of your investment gains. It's essential to understand how different investments are taxed and to consider tax-efficient strategies. For instance, long-term investments often have tax advantages compared to short-term ones. Understanding these fees and costs is crucial because they impact your overall returns. Make sure to read the fine print, compare options, and choose investments that align with your financial goals while minimizing fees. Investing is like planting a tree. It takes time to grow. Having a long-term perspective means you don't expect your money to multiply overnight. Here is why this is so important. Market fluctuations. The financial markets can go up and down in the short term. If you panic and sell when the market drops, you might miss out on potential gains when it goes up again. Having a long-term view helps you ride out these ups and downs. Compounding. Over time, your money can grow not just from your initial investment but also from the returns it generates. This is called compounding. The longer you leave your money invested, the more it can grow through compounding. Goals and patience. Many financial goals like retirement or buying a home are long-term. By investing with a long-term perspective, you are more likely to achieve these goals. Patience is key to success in investing. Reducing stress. Constantly checking and worrying about your investments can be stressful. A long-term approach lets you focus on your life instead of daily market fluctuations. To adopt a long-term perspective, define your financial goals, create a diversified portfolio, and avoid making impulsive decisions based on short-term market movements. Remember, successful investing is a marathon, not a sprint. Investing is not a set it and forget it process. It's important to regularly review and adjust your investment strategy to stay on track with your financial goals. Here's how to go about it. Regular check-ins. Periodically review your investments at least once a year to see how they are performing. Are they meeting your expectations, or do adjustments need to be made? Rebalance. If your investments have shifted from your target asset allocation due to market changes, consider rebalancing. This means selling some of what has done well and buying more of what has underperformed to bring your portfolio back in line with your goals. Life changes. Major life events like getting married, having children, or changing jobs can impact your financial goals. Adjust your investment strategy to align with these changes. Risk tolerance. As you age or as your financial situation changes, your risk tolerance may change too. Make sure your investments match your comfort level with risk. Seek professional advice. Sometimes it's a good idea to consult with a financial advisor. They can provide guidance and help you make informed decisions. By reviewing and adjusting your investment strategy, you can ensure it remains in line with your evolving goals and risk tolerance. This flexibility is crucial to stay on the path to financial success. Remember, investing is a journey, and regular check-ins can help you stay on the right course. Now you know how to invest. Next, we will cover you how to take care of the income tax.